All right, so we're in chapter 15. Now, chapter 15 deals with investments. Much of what you learned up to this point, you'll be able to continue to use because, for instance, in chapter 13, you sold stocks. In chapter 15, you'll buy stocks. In chapter 14, you sold bonds, but in chapter 15, you'll buy bonds. So in many ways, it's the mirror image of what we've been working with in 14 and 15, 13 and 14. So investments. You can have short-term investments. Of course, as you guys remember, short-term investments are those that you'll turn into cash within a year or an operating cycle, which is ever longer. Now, but don't forget, cash equivalents, those that'll be converted to cash within 90 days, and the value is known. So cash equivalents, they're very near to cash. They're practically cash. So in many balance sheets, you'll have a category, cash and cash equivalents. So it's the actual cash you have, but those that you're going to turn to cash in the very near future. So here, they're practically cash. I was just going to record this. Okay, all right. Oh, I see. There you go. Sure thing. There's a couple of them there. All right, good. I wonder whose that was.
Meeting. Thank you so much.
You're welcome. All right. Now, long-term investments are not really converted into cash. In essence, what the thing is, management plans to keep them for more than a year or an operating cycle, which is ever longer. Okay. Debt securities, those where there's a creditor relationship, you're lending money. Equity securities is ownership. You're actually buying stock. Now, this scheme of things will help you really understand it. We have trading securities, held-to-maturity securities, available-for-sale securities, significant influence, and controlling influence. Now, each of these categories determines how you do the accounting. I'm going to move this to make sure we're including everything here. So, what we have here then are, if management decides to label it a trading security, it can either be debt or equity. It's adjusted to fair market value. What's unique about trading securities is unrealized gains and losses go to the income statement. So unrealized gains and losses. At the end of the accounting period, you take out something like the Wall Street Journal, and you find the current market value for your equity, for your either debt or for your bonds, stocks and bonds, and so then you find, compared to what you paid for them, cost, what they're currently worth market, and that will be a gain or a loss. Those gains and losses then are reported on the income statement, and it's down there with other revenues and expenses down at the bottom, right? And so if it's a gain, it will be revenue, increase your net income. A loss will decrease your net income. Okay. Held to maturity. This means the company, you bought a bond, you're going to keep it till it matures. It's only debt. It's held to maturity. Insurance companies do this. If you bought the bond at a premium or discount, you adjust it to, you amortize the bond, you adjust it to its present value, which means that you amortize either the premium or the discount. Okay, bring it up to its present value. Available for sale. Now, this category of investment says you own less than 20% stock of a company. You really don't have any influence. So an example is easy to see. Suppose a company sold 100 shares of stock in total to all the investors, and you bought 5 of those shares. Well, that's less than 20%, and it's non-influential. You do adjust for fair market value, but now the unrealized gains and losses are reported as an owner's equity account. They don't go to the income statement, they go to the balance sheet. If they're a loss, they have a debit balance, they decrease equity. If they're a gain, they have a credit balance, they'll increase your equity, but they show up, they're reported as part of the balance sheet. Significant influence, that means you own more than 20% of the stock, but less than 50%. And that's reported using the equity method. So, if the subsidiary has a good year and they make an income that increases the equity, their equity balance, and your investment increases correspondingly. So, if their value increased by 10%, your investment increases by 10%. If it went down by 10%, your investment goes down by 10%. So the value of your equity tracks the increases and decreases in the value of that particular business in their equity section of their balance sheet. Now, let's take a look at some accounting fundamentals. Let's go over here, okay? So if we go over here, don't forget, now what we have here is we have the mirror image of chapters, in this case it would be we have a mirror image of chapter 14, because now what we're doing is we're buying the stock, right? So we're buying so in this case it's debt security, so we're buying the bond. So when you buy a bond, you record it at cost, interest shows up as revenue in the income statement, it's recorded when it's earned, okay? All right, it's recorded when it's earned. So for instance, in this example, they paid $29,500 for the stock. Thank you. All right. So anyway, paid $29,500 for the in this case for the bonds. There was a $500 brokerage fee. Add the two together, you recorded at cost. So in this case, you debit long-term investments at the $30,000, which is what you actually paid for it, and you credit cash. Now there's 7% 2-year bonds. So then, at the end of the accounting period, you do an adjustment. So you have principal times rate times time, so 30,000 times 7% times 4/12, because you bought it September 1st, December 31st is the end of the year, September, October, November, December, that's 4 months. So 30,000 times 7% times 4/12 is 700. So the adjusting entry is you debit interest receivable for the 700, credit interest revenue for the 700. Then, when you actually receive the interest, okay, so when you receive the interest on February 28th, now, principal times rate times time, so 30,000 times 7% times 6/12 is 1,050, that's the cash you received. Then you have 30,000 times 7% times 2/12, because January and February are the interest you earned in this accounting period, that's 350. And then you pay off the 700 interest receivable from the previous accounting year, okay? Then, when you sell it, in this case you sold it for 30,000, you debit cash and you credit long-term investments. So, in other words, another way of saying the same thing is, when it became due, when it matured, the company who owed you the money sends you the money, you debit cash, you credit long-term investments. Now, as part of this review, let's take a look at equity securities. Now what you're doing is, in Chapter 13, you sold stocks. In Chapter 15, you buy stocks. So when you buy stocks, in this case you bought 1,000 shares of this company for $86,000. So you debit long-term investment for 86, you credit cash for 86. When you receive the dividend, in this case you received a dividend of 1,720. You debited cash, you credited dividend revenue, okay? Now you sell 500 of these shares and you sell them for $45,000, okay? So if you paid $86,000 for 1,000 shares, that means you paid $86 each. When you sold 500, the cost of the shares you sold was $43,000. The journal entry will have cash $45,000. That's what you sold them for. Long-term investments are credited for cost $43,000. Okay. There's a difference of $2,000. It's a plug figure. It's a credit, so it'll be a gain on sale of long-term investments. Now let's kind of get into this chapter. Here we have trading securities. Now trading securities can either be debt or equity. They're actively managed. They're reported at fair value. And unrealized gains and losses go to the income statement. We reported that earlier in our overview, but let's go ahead and report it now when we're dealing with trading securities specifically. So let's go through just some of the transactions as an example. So in this case, what you did is, I'm going to move that camera over to make sure it's lined up well enough. So in this case, make sure we're on the board. So in this case, what we do, we have a portfolio of trading securities that cost $11,500. So the cost is $11,500. Okay? Then, at the end of the accounting period, we take out the Wall Street Journal, and the fair value, okay, the fair value the market value, if you will, of all those is $13,000. So the fair value is $13,000. That meant we have a $1,500 gain. Okay? So here's what we paid for it. Here's its fair market value at the end of the fiscal year. That meant there was a gain. This will be an unrealized gain because we haven't sold these. We still own them, right? It's an unrealized gain. So the adjusting entry for that will be fair value adjustment trading . And that will be a debit of $1,500, and you have an unrealized gain dash trading of $1,500. Now this will be December 31st. Now what's important to realize here is the fair value adjustment. This is a permanent account. Okay? In this case, it would be an adjunct asset because it increases, it's a debit, it'll increase the value of the asset. If it was a credit balance, it would be a contra asset, but they're permanent accounts. So you guys remember when we had the accumulated depreciation, which is a contra asset? At the end of the fiscal year, its balance rolled over the next year. It was not a temporary account, it was a permanent account. Well, this is the same type of account as that was. The unrealized gain or loss, that's a temporary account. And this closes to the income summary. Okay? And of course, it also shows up on the income statement. Okay? All right. So this is an unrealized gain or loss. And so what we have here then is, so in this case, we go to the balance sheet. We have under the current assets section, we will have short-term investments. This will be an asset. This would be valued at $11,500. And of course, that's cost. Then we have fair value adjustment. In this case, that's $1,500. So now, $13,000 is the short-term investments at fair value. Okay, so this fair value adjustment shows up on the balance sheet. In this case, it's there was an increase. It has a debit balance here, so it'll increase the value of the asset, and then it will show the fair value adjustment. So that's what it looks like on our balance sheet. Okay, and it's a permanent account. This went to the income statement, the unrealized gains or losses, but only for trading. Then what we did is we sold some shares. They cost $1,000. We sold for $1,200. That means we had a $200 gain. So this specific shares, it doesn't say how many. They cost us $1,000. We sold them for $1,200, so we have a $200 gain. We did this on January 9th, and the journal entry looks like this. So the cash will be debited for the $1,200. That's the cash we received. Our short-term investments will be at cost. and then we paid $1,000. We have a $200 plug figure that's a credit, and that will be a gain on sale of short-term investments. And the name for this is a realized gain. And with a realized gains in every case will always go to the income statement. So we have an unrealized gain, which is an adjusting entry. We haven't sold the stock, so that's why it's an unrealized gain. It only merely adjusts it for the current market value at the end of the fiscal year. In this case, we actually sold it. So when we sold it, we have an unrealized gain, we have a realized gain or a realized loss because we actually made the sale, and all realized gains and losses do go to the income statement.